So credit markets were impacted for the tariff announcement, and we saw around Liberation Day spreads widen significantly. So high yield spreads widened sort of 100, 150 basis points, but actually they retrenched pretty quickly afterwards. Actually, within sort of 5 days, they'd started performing again, and actually now are tighter than where they were before the tariff announcement. Other geopolitical uncertainty hasn't weighed that heavily on credit markets. Credit markets have been quite buoyant recently, and so it's really the only big change in credit spreads was around Liberation Day. So actually credit spreads are actually pretty similar if we look in Europe and the US, but what is different is the makeup of the market. So the US market is a lot lower rated. So if we look at sort of double Bs, there's 70% in Europe, whereas 54% in the US, and the bottom end of the scale with triple Cs, 10% in Europe, 10% in the US, and 5% in Europe. So credit risk is much higher in the US, but you're getting the same spread. So actually, you've got you get sort of more the same spread, but less credit risk in Europe, and so that's where we'd favour at the moment. Okay, I think generally we'd say that higher quality than lower quality, just because of where spreads are. And so generally spreads are compressed between, say, single Bs and double Bs. So we have a preference for double Bs. Some sectors have quite a lot of dispersion. So like chemical sector, which is a bit under some stress with poor economies and supply from China. So there's some winners and losers there. Similarly with autos, which is a sector that is subject to lots of tariffs. We've seen opportunities within that sector where some issues have sold off. So, M&G, we have a very large credit team, and they're responsible for putting a credit rating on all the issues. And as the portfolio management team looks at those ratings and sees the opportunity in the market, and it's very much looking at how the market prices something versus how we rate it. And it's about, for the fund, it is about scaling in and scaling out of those positions as the market values change. Because what we tend to see is the fundamentals don't change that much over time generally, but market valuations move all over the place. And so it's looking for when those dislocation between the market and the fundamentals, and that's when we see opportunity. So in terms of the fund, we are sort of duration neutral versus the benchmark. So all we're doing is focusing on the credit spread risk. Okay, so we're just looking at credit stock selection. We hedge out any duration risk, we hedge out any currency risk. So we're just focusing on credit. And then it makes it a bit easier because all we're focusing on is the spread you're getting versus what we perceive to be the credit risk. And so we're sort of trying to isolate all those other risks and just focus on those on the credit risk there. So in terms of ESG, the fund's an Article 8 fund, and so we exclude some sectors like sort of tobacco and gaming, thermal coal, and all our analysts produce a scorecard, an ESG scorecard for all the issuers to see if there's any factors that could impact the credit over time. Yeah, so if you over the long term, high yield has outperformed. The last 20 years, high yield's outperformed investment grade by about 3% per annum. So it's a huge outperformance. And actually, even if you look at shorter periods, it outperforms most of the time. And so it should be a building block of a fixed income allocation, we think. And today, yields are around 5%. You get a lot of cushion from also protection from yields rising because the asset class is quite short, and so so yields have to rise almost 2% before you lose money on a 12-month view. So there's a lot of protection in the high yield market at the moment. For instance, our fund is more defensive at the moment because spreads are tight. But the key point is to have to be flexible to move and take more risk should spreads widen out.